Okay, let's dive right into this explainer. Today, we're putting on our sell-side equity analyst hats to produce a rigorous, fundamental valuation of Patterson-UTI Energy. You probably know it by its ticker, PTEN. We're going to build a fully documented stock valuation based strictly on the current data. So let's just get right to work. Now, check out this massive 105.53% year-to-date return. It shows absolutely incredible market momentum. The stock has been surging, right? Boasting a trailing 12-month total return of over 116%. That kind of explosive price action immediately grabs your attention as an analyst, and it really begs the question, do the underlying fundamentals actually support this massive rally? But flip the coin, and we hit a glaring negative 49.64 price-to-earnings ratio. And this creates an immediate, frankly fascinating mystery. I mean, how exactly is a stock doubling in price while simultaneously losing money on paper? A negative PE means negative net earnings. So we have to ask ourselves, what is the market pricing in that the accounting bottom line just isn't showing yet? Well, that's exactly what we're here to figure out. To figure that out, we'll walk through our baseline financial overview, build a DCF, absolute valuation, look at alternative models like DDM and RI, deal with some missing data via APV and SOT, run through relative and asset valuations, and finally deliver our intrinsic value verdict. Section 1. Baseline Financial Overview. This beautifully illustrates the structural contradiction right at the heart of PTN. We're looking at a market cap of about $4.7 billion with a current price of $12.41, and they're pulling in an impressive $4.8 billion in trailing 12-month revenue. But look a bit lower, a negative net income of roughly $93.6 million. Yet, right below that, they actually generated over $372 million in positive free cash flow over that exact same period. This massive divergence between accounting profit and actual cash generation, which is often driven by heavy non-cash charges like depreciation in the energy sector, is the absolute key to understanding this company's true value. Section 2. Absolute Valuation, the DCF. Here are the key inputs and assumptions we're using for our discounted cash flow model. We've elected to use free cash flow to the firm, mainly because PTEN has a very stable low debt-to-equity ratio of just 0.38. We're inputting our actual trailing 12-month free cash flow of $372.19 million. For growth, we're applying the company's actual historical 5-year free cash flow compound annual growth rate, which sits at a very robust 22.77%. Now, as professional analysts, when a filing doesn't explicitly hand us the terminal rate or discount rate, we have to rely on sensible external assumptions. So we're estimating a weighted average cost of capital, essentially the blended cost the company pays to finance its assets, somewhere between 8 and 10%. And we're plugging in a standard 2 to 3% terminal growth rate just to keep the long-term model properly grounded. Building a bridge from reported financials to an actual target price requires 4 pretty straightforward steps, based purely on the cash the business generates. Step 1, we isolate that $372 million in free cash flow. Step 2, we project those cash flows forward using that historical 22.77% growth rate for our explicit forecast period. Step 3, we discount those future cash flows back to present value using our assumed WACC. And finally, step 4, we divide by the shares outstanding to arrive at our intrinsic value per share. Running all that math gives us a calculated fair value price of exactly $13.70 per share. Remember, looking back at our baseline, the stock is currently trading at $12.41, which means our absolute DCF model is immediately flagging PTEN as undervalued. Section 3. Alternative Models, DDM and RI. Looking at the dividend discount model, PTN offers a yield of 3.22%. The 3-year dividend growth is a steady 7.71%, while the 5-year growth looks absolutely spectacular at nearly 38%. But look closely at that current payout ratio. It is sitting at exactly 100% of net income. Even though the free cash flow payout ratio is much healthier at roughly 36%, that 100% earnings payout makes projecting a multi-stage dividend discount model highly sensitive, and frankly, it's potentially unreliable for a strict long-term equity valuation. Similarly, trying to apply the residual income model presents some immediate issues. You see, the RI model relies heavily on book value, and PTEN currently has a price to book of 1.46. The problem? Well, PTN's return on invested capital is negative 0.91%, and its return on equity is negative 2.91%. In a residual income framework, negative returns effectively destroy equity value over time. Because this model relies so heavily on accounting net income, which we already established as negative, it would unfairly penalize the company and completely ignore those robust free cash flows we just analyzed in the DCF. So as disciplined analysts, we're just going to set this model aside. Section 4. Dealing with missing data, APV and SOTP. As analysts, we always want to consider sum of the parts and adjusted present value models to get a more granular look at a business. However, a sum of the parts valuation requires distinct, reportable business segment financials. Our source data only provides consolidated, parent-level metrics. So, SOTP is theoretically appealing, but practically impossible to execute here. Additionally, an adjusted present value model separates the base firm value from the tax shields provided by debt. But according to the data, PTEN's trailing 12-month tax rate is exactly 0%. Without a tax burden to shield, the APV model loses its distinct utility. We have to explicitly state these limitations and skip these models to maintain our rigorous standards. Section 5. Relative and Asset Valuation. Let's see how PTN stacks up relatively. We pulled these multiples directly from the company filings. The forward PE sits at a very reasonable 11.11. The price to book is 1.46, and the price to free cash flow is 12.64. Most notably, the enterprise value to EBITDA ratio is just 6.14. Now, keep in mind, selecting the exact peer group to benchmark this 6.14 EV to EBITDA against is an external assumption we have to make. But within the broader energy and drilling sector, a 6.14 multiple generally indicates a company that's quite attractively priced compared to its cash-generating peers. Evaluating asset valuation, PTN shows really strong baseline health. The current ratio is 1.64, and the quick ratio is 1.46, both indicating solid short-term liquidity. But look at the EV to assets ratio. It's sitting at exactly 0.99. This means the market is pricing the entire enterprise basically at parity with its accounting assets. The net asset value here strictly supports the current enterprise pricing, providing a very solid floor for the stock value. Section 6. Final Intrinsic Value Verdict. By bringing together the absolute DCF output with our relative and asset-based sanity checks, the picture becomes incredibly clear. The relative multiples suggest undervaluation compared to cash flows. The asset-based model suggests it's fairly valued against its balance sheet. But our primary driver, the strict free cash flow DCF model, gives us a calculated fair value of $13.70. Compare that to the current market price of $12.41. The delta between the current price and our calculated fair value yields a built-in margin of safety of exactly 9.40%. This means that, based strictly on the massive free cash flows this business is consistently generating, despite what the negative accounting net income implies, investors are currently getting a nearly 10% discount to its intrinsic value. But, numbers don't exist in a vacuum. Which leaves us with one final, absolutely critical question to ask yourself before drawing any conclusions from this explainer. Is a 9.40% margin of safety enough compensation for taking on a company that, despite its incredible cash flow, carries negative net income and highly skewed dividend payout ratios? Valuation is part science and part art. We've done the rigorous math, but how you weigh that risk? Well, that's up to you. Keep analyzing, keep asking the hard questions, and I'll catch you in the next explainer.